Hi, I wanted to take some time to talk about my views on the market, what's been going on so far this year. Basically, it's been an interesting market from the standpoint that obviously the stock market itself is at an all-time high. Bond yields being as low as they are really means that it's at an all-time high too. The real estate market has taken off in the Puget Sound region and a little bit nationally, but mostly regionally. What does that mean? Are we in another bubble situation? What areas have been moving in what direction? I want to spend a little bit of time on that because often what happens in these kinds of markets where certain areas are doing really well, for instance, technology stocks, the largest companies in the world are doing great, as well as rental real estate. So you might go out, well, I think I should go buy some Amazon and buy some rental houses, and maybe you're buying high, maybe not. So I want to kind of dissect that a little bit so that we don't just run out and follow the pack and then sometimes follow it off the cliff. So that's an important consideration here. So some of the interesting stats that I found on the market itself. When I talk about the market, I'm talking about the S&P 500 or the Dow. The S&P 500, for instance, is heavily weighted towards the largest technology companies. Now, when they're taking off, so does the S&P. So obviously, if you have a lot of your eggs in that basket, you're doing really well this last year. In fact, I've got the stats on some of those companies. Apple so far this year is up 43%, Google 29, Microsoft 33. This is just part of a year. Amazon 47% and Facebook 53% so far this year. So obviously that's kind of alarming in a couple of ways. It's amazing that these size companies can go up that much in value in less than a year. Either nobody knew what they were worth a year ago, or all of their business models have just revolutionized profitability, or people are jumping on the bandwagon, or some combination of those three. As I look at the valuations of these companies, it's interesting to note that Apple, Google are right about where they should be based on historical valuations. Facebook actually is underpriced. Microsoft is kind of pricey right now. Amazon, there's just no way to read it. It's got a price earnings ratio of 141 times earnings. Now, most people consider that absurd to buy a company like that, but it's always been a company that's never made any profit. But there's a lot of built-in hope that someday it will have a profit. So that's why it's probably the most valuable company on the planet right now, even though it doesn't make a profit. So that's a tough one to dissect. Um, the market itself, the broader market, the S&P 500 is not up anywhere near that percentage. We tend to buy FWDD, which is the valuation-based approach, so that if we had a decline, we're hoping we'd be in a more defensive posture. It's year-to-date, as of the reading of this, up over 13%. The internationals, especially emerging markets, have done really well this year. So FWDI has gone up over 23% as of the reading of this today. The day before Halloween is when I'm recording this. The bond fund has actually done well. Bonds have been a tough area to be in. The index is not doing real well, but our FWDB, the bond fund, is up over 6%. The high yields are up over 6.5. One area that's interesting, in the past we've always wanted to allocate to high dividend paying U.S. stocks, kind of the blue chips, the steady eddies that pay the high dividends, and that can be a good approach. But while the technology stocks are soaring, the high dividend fund is only up a little over 7% this year. That's still good, but it's not as much as normal. Small cap funds, stocks are only up a little bit over 10% this year. Usually when the market's up, they're way up. So they've been lagging the broad market because of the large cap tech. And finally, preferred stocks are up about 8% or more this year. So have a mix of a lot of those different kind of holdings in our portfolios. I think it would not be real prudent just to dump a lot of money in tech stocks while they're up this high. I just don't know how much longer the rise can continue in them. Obviously, it won't be 30, 40, 50% every year. So we have to be careful about buying at the high side, but I think our portfolios reflect a nice mix of the different areas of the market. And one reason I say that we don't want to just jump on the bandwagon is if we look at the last 15-year returns of different areas of the market, you might be surprised. I mean, one of the areas that hasn't done very well in this last year are publicly traded REITs, real estate stocks. And because everybody's jumping on the tech bandwagon, in the last 15 years, it's got the highest rate of return of these 8 major asset categories I'm going to read out here. Second highest is emerging market stocks. So that would be China and sometimes South Korea, different countries, India, those kinds of South America. That the smaller equity markets, but large countries that don't have large economies necessarily, except for China. Third on the list is high yield bonds. Fourth is small cap U.S. stocks. Fifth, large cap U.S. stocks. So all those tech companies would fit into that. Sixth is international equities, the developed markets, so Western Europe and Japan primarily. Seventh is bonds as a mix, and I would agree that that is probably not going to be good going forward. Last on the list is commodities such as oil, gold, precious metals, that kind of thing. We don't have an allocation to that of any significance. So it's interesting historically to look at the markets and say, gee, just because something's up right now doesn't mean we want to jump on that bandwagon. Well, certainly we have allocation to that, but we're not entirely allocated. So if you hear certain parts of the market are doing really well, understand in any diversified portfolio, we have some of that, but we're not going to put all our eggs in that basket. Now, one of the things I've been doing a lot lately, a lot of the speeches I've been giving and so forth, is about really a new asset allocation philosophy. In the past, and certainly nationwide right now, a lot of people are investing in a mix of cash, bonds, and large cap U.S. stocks. That's the typical mix that any brokerage firm puts out there. Now, obviously the problems are with cash, you can't get any real rate of return. With the bond market, it's again at near an all-time high, and I just don't think rates are going to continue to fall year after year like they have the last 30 or so years. So with rate yields so low on bonds, it's really not a place I want to have a big percentage of our investments. So I've been talking about bond alternatives a lot. The primary alternatives are 3. One is the private REITs. I've met with a lot of people recently whether we're talking about investing in the primarily multifamily Class A apartments, really nice apartments across the country that the millennials like, or another REIT that I really like is focused in the two big growing sectors, data storage, so essentially the cloud computer buildings that they lease out to these companies, and healthcare facilities that are doing the actual surgery type procedures. These are high equipment, high capitalization type buildings that have real nice yields and the potential for appreciation. All the while, they have a really nice cash flow and they're not really correlated to the stock market, meaning that if the stock market drops 20% and you have a part ownership in apartment buildings, the tenants don't get a call that day saying your rent just dropped 20% because the market dropped. It's not correlated to that. So I like it from that aspect. So it has a lot of the good things we want, non-correlation, great cash flow, depending on which ones we're in, they differ. Two other areas that we diversify into are both fixed indexed annuities. One is designed for safe growth, and the other one is designed for some growth that's safe from loss, but also adds the lifetime cash flow component. That's generally best for people under 60 years old. The other one can be used for anybody that wants to protect some of their portfolio. So I've also been talking a lot about DSTs, Delaware Statutory Trust. That is for all the people out there that have any kind of real estate that's investment real estate where they have a gain and they maybe want to sell it. Well, anybody wanting to sell real estate around here is probably selling it at a big gain, and I would assume you don't want to pay big taxes on that. If you are selling, you want to replace the cash flow that you've been used to if it's a rental. So we've been talking about DSTs. I have a lot of information I've typed up about that, published, and I have speeches about that. So if you have some kind of real estate that's appreciated and you want to have a discussion about how to maintain the potential step up in basis, not pay taxes on the sale of your property, have really nice cash flow, underlying appreciation, and so forth, then you can talk to us about that. So as I've been talking to people about reallocating their investments from cash, bonds, and stocks, and often a lot of people are in a 401k plan, they retire and they have to do that. That's all they've had a choice of is cash, stocks, and bonds, and now they have the potential for allocating into different mix of real estate, different kinds of annuities, maybe even senior loans, which is another kind of investment strategy that has a very high yield, defensive-minded stock funds, maybe paying off debt. That might be something you want to look into. So a lot of the different people I've been talking to, they have different things they have to analyze, and we don't want to invest like people have over the last 30 years with that big bond allocation, in my opinion. So if you're looking at maybe a pension buyout coming up or some kind of change in how you want to allocate your assets, maybe have access to the assets either through a sale or an inheritance or a retirement, or you just want to look at different options, obviously we can help you with that. If you think your own portfolio may be a little bond heavy, maybe you came to me years ago and said, yeah, I want to be real conservative. Well, typically conservative meant bonds at the time. But now that bonds have peaked, we might want to revisit that. So if you have some questions about that, we'd be happy to talk to you about alternatives, either in the fixed income space, fixed index annuity space, I should say, or the real estate space. So all in all, the quarters, obviously looking at your statements, the markets tend to have been going up. The rate of returns have been very good over the course of this year to date, and certainly over the last 12 months, given the Trump bump that we had. One thing I wanted to comment on, I get asked this a lot, are markets going to crash just because they're up so much? And so with that, I look at the valuation of the different markets. The price earnings ratio of the U.S. market right now is about 17.7. That's probably about 10% higher than it usually is historically. That's not something to be too alarmed about, though, because actually profits are growing nationwide. This last quarter, they were the highest ever recorded in history, and profits drive markets. Internationally, the price earnings ratio is only 14 times earnings, so that equates to about 7% to the bottom line on the equity. So there is a reason why the markets are where they are if you believe that profitability of companies drives their value, which I do. And so it's not something I just look at and go, oh, it's up, I need to sell and get out. So, one party says, oh, the market's too high, we got to sell, and the other party says, well, the markets look good going forward, maybe we should buy tech stocks. So I think we want to be disciplined and just have the proper allocations so that no matter what the markets do, up or down, that we have enough safety in our portfolio, diversity in other asset classes, cash flow, liquidity, all the different things that we want to have, and that's really what we're striving for. So that kind of sums up my comments on the market here for this quarter. Appreciate you listening to this, and as always, feel free to call us, or if you know somebody that might want to sit down and have their plans looked at, feel free to give our name out, as we always like to meet with new people that have questions on the financial side. So enjoy the fall coming up, and we'll talk again soon. Thank you.